Here we are, folks. Another Tuesday evening. Welcome, welcome. Great to have you all on, and nice to see some of the old faithfuls popping in again. Hope everybody is well. And I was chuckling just looking at the weather in Australia at the moment. Believe it or not, it's colder in Australia than it is in the UK. Of course, in the UK, it's the middle of summer, and we had 2 warm days. We got up to 27 degrees, and people started complaining. But we're now back down, much colder again. But winter there, and summer here, at least for a little while. And as normal, of course, we're on just the pre-show waffle for a second or two. Let people come in. Here are the dogs. Duly ensconced after their walks and after their lunch, so they'll hopefully be quiet for the show. Who knows? Never can quite tell. And here, of course, is the studio. Damien's teed up, ready to come in over there, as you can perhaps see. We've got the multi-view up, we've got the chat up, we've got control systems here, the various other bits and bobs going there, and over there, the computer that's running the controls for the streaming software and hardware. And it's all working, hopefully. I did have a couple of flickers on my screen a little while ago. So if I suddenly disappear, and don't panic, I'll have to reboot the that part of the system. But I think it's okay, hopefully. As with all of these things, it's a bit of a large integrated system, and occasionally things don't talk to each other properly and all sorts of weird things happen. A bit like the real world. Okay, let me take that off. And I'm going to start the show formally, and then we'll get going with Damien. Well, good evening and welcome to this live stream on the 2nd of July, 2024. Martin North from Digital Finance Analytics here. Great to have you on this evening, and thanks very much for taking some of your time out on this Tuesday evening. Going to have a very interesting conversation today, specifically about investing in the current climate, what's happening with regard to some of the recent trends. Is Nvidia going to go up, going to go down? What does it mean for the broader markets? What's happening in Australia with interest rates and all sorts of other things? Of course, as normal, we'll be able to take your questions. Just before I get Damien to come in, let me just remind you, we're not providing specific legal or financial advice, general conversation only. We do moderate the chat, but feel free to throw your questions and comments in. If you'd like to ask a specific question of Damien or myself, if you use that Walk the World, it makes sure that it gets into my queue. And I've also enabled Super Chat, which means that if you want to, you can get your question to the top of the list, or indeed make a contribution to what we do around here. Always greatly appreciated. Don't do this for profit. We do this because we think there's a really important conversation to be had, and we really appreciate those who support us to enable us to do what we do. Right, let me bring Damien straight in, and we'll get going. Damien, good to see you again.
See you too, Martin.
How you been?
In a little while. Yeah, not too bad. Not too bad. It is. You're right. It is cold here. We've had,
yeah, surprisingly so. And interestingly, of course, with the the midwinter situation, with people looking forward to the warmer climes ahead as we move into the southern spring. Bit the same with the markets, I feel, at the moment. I'm not quite sure what's going on. Right, with we had a big run up. The performance overall looks like being pretty good over the last 12 months, but I guess there are some interesting questions that are beginning to emerge now.
Yeah, look, lots of interesting questions. I think there's, as you alluded to, a lot of it all comes down to the tech side, and it's well worth having a bit of a chat around that. I think the one thing I do want to talk about a little bit is this similar enough to the tech boom that you can sort of start thinking, well, what happens if we're sitting in 1999 at the moment? The equivalent. What does that mean? What do the ratios look like? How much upside is there? What's all that type of stuff? I think it's well worth having a bit of a discussion about. And then around that, certainly in terms of earnings, I've spoken ad nauseum over the last few years. Earnings do not look particularly flash in a whole bunch of different areas. But where they do look good is in that whole tech area, and certainly anything to do with AI. It has some genuine earnings there. Sorry, not anything. There's a lot of companies that don't have genuine earnings in the AI space, but there are some, a number of companies with genuine earnings and a few positives, a few things that I think are different as well in actually a bit of a more positive way than the tech boom. So we'll talk about that in a bit more detail, I'm sure. And then there's Australia decoupling, inflation here versus inflation elsewhere, interest rates here versus elsewhere, those types of factors. And also since we spoke last, we sort of went through a bit of a boom bust for copper. We spoke about it being, and some other metals as well. Copper was back to the boom metal, and you had to have some, and you had to protect yourself from inflation until some of the investment banks got sick of it again and sort of ran it up, and it's sort of in the process of running it back down again at the moment. So maybe have a touch on that at some point as well.
Well, I think those are all good subjects, and I would make the observation that there is a lot of speculation out there, and a lot of traders looking for the next thing to sort of ride up and then take profits and then run away again. Remind everybody also, of course, that because of the significant increase in liquidity we've had in recent years, all the massive amounts of money sloshing around the system, one of the things that I always come back to is just how much money there is looking for a home. And one of the real interesting observations there is that there's way more than previously. And interesting, I was reading something the other day that suggests that quite a lot of that money is held with people who are now in the older age groups and into retirement or actually retired, and that's changing some of the mix in terms of some of the investment strategies. We've also got big hedge funds, of course, that have lots of money to play around with as well. And then the other point that's there, of course, you've then got this question of the index funds versus the non-index funds and the mix there. All of those things have really, well, in a way, messed the markets, haven't they?
Yeah, well, I mean, the markets have always been pretty good at bringing people in and chewing them up and spinning them out as well. But I thought, can I show the copper price? I've just got that up on chart here because I think it's instructive as to, there's a number of big investment banks that are out there right throughout 21 and 22 talking about, you've got to have copper, you've got to have commodities. It's the only way to protect yourself from inflation is commodities. It's the only way. And most of the rise had already been done by the time they were out really pushing it in the media. And, it lasted up on that peak for another 6 to 9 months or maybe even a year. But it was a pretty sharp fall down the other side, 20, 30% drop. And if this was this was the asset you were choosing to protect yourself from inflation, and you've got all these investment banks telling you to buy it with your ears pinned back at $5 because they were selling it to you because they'd already got into that trade a few years earlier, and they're just trying to find somebody to sell so they can get back out of it. And then that crashed, and you didn't hear much about it. And then we went through this recent period where we again ran from $3.50 up to $5. It's a pretty. I don't know, quite made 50%, but it was pretty close to 50% rise. And again, very much driven by investment banks and the whole Wall Street, the thundering herd cheering it on. You got to protect yourself from inflation. Got to protect yourself from inflation. And again, if you bought at $5, you've peaked out and you're down 10% so far. And this is what they do. They come up with a great idea. It's great to have a little bit of an element of truth to it, and then the rest of it's all about pushing and getting people onto that, creating that narrative, getting people to buy, and then on the other side getting them to sell, because that's how you make money. You don't make money in investment banking and stockbroking from telling somebody to buy and hold for the next 20 years. You make money from telling them to buy now, and 6 months later, time to get out, quick, get out, and then back in again, and ideally. What they're doing is they've got their best clients in early, and then it's everyone else who's then they're using to get their best clients out as they're sort of realizing their profits, and then rinse, repeat. And so I guess it's just a warning, a buyer beware, is that when people are giving you investment advice, and I think that obviously fund managers have got their own vested interest, and I certainly have my vested interest in what I'll talk about stuff that I already own. But it's keeping in mind that that's what people will talk about. They're not going to talk about, you listen to fund managers, they will generally say, "This is something I already own this story, and come along for the ride with me," which is, again, it's not the greatest, but at least it's better than, "This is what I just sold to some of my clients, and I'm trying to convince somebody to buy them back out again." A lot of broking, you can get a story that's much more ephemeral, and so yeah. And there's certainly fund managers out there who will, go and bang the drum the loudest when they're trying to get out of that position themselves. That tend to be the bigger guys who've got relatively concentrated positions, and they'll be out there, on every news media possible, explaining why copper is such a great idea. In the meanwhile, in the background, they're busily selling, trying to get out themselves, because they know they need to have that demand coming from somewhere. So, yes.
And just bring that back to this concept of index, and the fact that, as market dynamics change, the indexes have to follow, don't they? And so if you think of the run up in Nvidia and big tech, by definition, the index funds have to actually buy on the way up, but also potentially, if they go down the other way, they might actually need to sell because they have to maintain the index positioning.
Yeah, so there's an element to this, and I think it's overstated in my view. There is an element in terms of, as the stock goes up through the indexes. So it starts as a small cap, and then so not that many indexes own it, and then it rises up into the ASX 200, say, and then into the ASX 100 and the 50, and then the 20, and more people are buying it all the way along. That certainly has that's a positive sort of push up. But in terms of and as it comes down, as it falls out of indexes, that'll have difference as well. But if it's in an index, say you're say a CBA or ANZ or something like that, and if you're and you're not changing indexes, so you're in that index. So anyone who's buying that index, they'll need to buy some CBA, but as that stock rises and falls, the index guys don't have to do anything, because if they own the stock, it's a 5% weight in the index, and then all of a sudden it doubles. Now it's a 10% weight. Well, I owned it and it just doubled, so I've just doubled my money, so I don't actually have to buy any more of it. So it's only really as indexes change, and so you do get this positive momentum through. But so I guess what I'm trying to get to on that is a stock like Nvidia, where look, it's the biggest stock in the world one day, or second biggest the next day. It's already in every index it's going to go into. Yes, there was a positive effect as it came into these indexes, but actually it was doubling revenues and doubling profits every sort of 90 days. So that was sort of that was more the main driver than going into indexes. And arguably the indexes came in late, because this thing grew so quickly that by the time the indexes were putting it in, a lot of the run had already happened. And so, so anyway, so I guess what I'm getting to is definitely makes a difference. But I think it sometimes gets overstated insofar as it's the changing as you go into the S&P 500 that makes a big difference. Once you're in the S&P 500, it makes much less of a difference.
That's very interesting, Damien. Now, one other thing I wanted to touch on briefly was just this particular picture, which is the equal weight S&P 500, right? And it's just worth bearing in mind, because of course we'll be talking about the tech sector, that from an equal weight perspective, you can see that over the last couple of years, it's gone almost nowhere, which tells you something very important about the potential concentration of the momentum. And in fact, you can quote a few different numbers in terms of what proportion of the total index is actually powered by the big tech sector, and within that, what proportion is Nvidia. The numbers are pretty stark.
Yeah, that's right. If you haven't owned Nvidia, then you've underperformed. Basically, it's very hard to not have performance without Nvidia. And so we're a little bit. Well, we're a late convert. I wouldn't say I'm converted yet, but there's certainly, I can see. I think it's worth talking about what is interesting about Nvidia that I think I certainly didn't recognize in the early stages. And it's got a bit of a compelling story that it's come out with. Now, I don't know how right it is, and I'd love to hear comments from it. I'm sure I will from people who know a bit about IT. But I might, if you've got 5 minutes to spare, let me craft the story because it's slightly nuanced in terms of it. And I do have that. I'll start with the sort of negative side of this whole industry. Is that Intel's been one of the biggest companies within that sector for years, and if I've got a few charts up to sort of showing the Intel profits on the left hand side. So for the last 2 decades, Intel sort of dominated for ages, and then and you can obviously see it's died off completely right at the end there in terms of earnings. But within that period where it was the dominant player in it, it pretty regularly doubled and halved its profits. It was, and this was the biggest and the best of the companies out there. If you look at something like Micron, which is one of the preeminent players in memory chips, it would go from 1999 it went up to sort of ran up $5 per share, then it made a loss, then it ran up to $1 per share, and then back to a loss again, then back to $1 a share for a while, and then back to losses, and then you can just see that it's just incredibly volatile in terms of the earnings you get out of this. So it's a nasty industry. You sort of have this. I've got a chart just up showing of the Pentium processors and how long it takes to roll off, and you're only as good as your latest hit. You've got 2 years to make money from it, and then then it's all gone. If you look at that memory sector again, this is just a chart of all the companies that have come and gone in that sector. All those lines on that chart, the first set of lines is all the US companies that used to dominate the sector back in the 70s. And then you ran into the Japanese companies in the 80s and 90s. And then finally, you sort of ended up with the 3 main players at the moment, which is Samsung, SK Hynix, and Micron. But it's just sort of showing that it's a nasty industry, and that you're only as good as your latest hit. As soon as you're not the fastest anymore, people are moving on. You just have to keep spending and spending and spending. You look at something like the leading foundries, gone from 17 foundries at the leading edge to 2 at the moment. And, all these massive players have all dropped off, Siemens and Mitsubishi's and Hitachis and Sony. And, they're not small companies that have all dropped off. And so, it is a nasty, nasty industry in terms of that. So you really don't want to be paying up for stocks within that sector. We spoke about about Cisco, and Cisco during the internet boom was this idea that I've got a chart up showing its EPS over the last 20 odd years, and so Cisco was this idea that it's going to run the internet. It does all the routers and does all that type of stuff, and so it's the hardware behind the internet, and so they're going to be the greatest stock because of it. And you look at the chart and you go, well, that's a pretty decent earnings growth. It's gone from pretty much a 45-degree line, sort of heading up over the last sort of 20 odd years. So that's great. Surely you must have made a lot of money from buying Cisco. But then you go back to the actual chart and you're like, well, no, you're down. You're way down on the purchase of. And sorry, that's an out of date chart as well. It's even further down. So if you bought anywhere near the peak, you're certainly way down on terms of what you would have made on it. So that's the sort of background, is saying, okay, at face value, you go, well, the value of the internet doesn't accrue to the people who have the routers. It doesn't go to the people with the picks and the shovels. It's not it goes to the rest of the companies involved. And the argument is similar with AI, is that, okay, so should the people who are doing the calculations get all the benefit for this, or actually should the people who actually create the calculations be the ones who are the ones who are really going to benefit from it? And NVIDIA's got this second part behind it, which is, well, they already had a bit of a boom bust only a couple of years ago, where they boomed on basically Ethereum and other crypto, not Bitcoin, but a lot of other crypto, wanting their hardware, and so that their profits doubled and tripled. And then as Ethereum went from proof of work to proof of stake, all of a sudden they crashed, and we never really knew how much it was because it was all bound up in their gaming sector. And so there's this idea that NVIDIA just got lucky, and in lots of ways it did. It got lucky. It had GPUs just when this AI boom took off. However, this is the interesting part. Is okay. So they've definitely been putting lots of these servers on, and they've got some of the best hardware and all that type of stuff, and they've built up a whole ecosystem. what they've been talking about is this plan for the data center of the future. If you look at Moore's law per chip, it's pretty much finished. So basically, the idea is that every few years you double your capacity and your productivity of a chip, and that's really faded off now. But what they're saying is, well, that doesn't really matter if Moore's law is actually working at the data center level. So if we've got a data center that's still doubling and its capacity and calculations every few years, then that doesn't matter as much. And if most of the calculations or a lot of the calculations going forward in data centers are going to need to be masses and masses of data, it's not a matter of saying, let's take lots of tiny little calculations and then we can add them all up later on and put them all back together again. Or we're just not doing, we're doing lots of tiny little calculations all over the place. Then you can run these off the chips of yesteryear. But if we're actually talking about saying we need to keep masses and masses of data very close to each other and run these big calculations across all these calculations, across these massive data sets, then we're actually talking about a completely different mode of data center. And what they're pushing as their story for this is saying, well, one step is saying these graphic processing units, which basically are so the idea is that a CPU from your old computer is a very good generalist. These graphics processing units were very good at doing screens for video games, but actually the same calculations happen to be the same calculations that are being done for AI. So it's very efficient in terms of that sense. So what they're talking about, or what they're doing, is they've got first they have this technology HBM3, which is about getting some of the memory sort of embedded within the chips and stacking memory and stacking these GPUs like on the chip itself. Then they've got this NVL, which is about getting these GPUs to talk to each other in a very efficient way. And then finally, so you're basically saying, okay, well, if they can be very good at putting all these chips next to each other, integrating it with the memory so it talks very well with each other, and then getting masses of these GPUs to talk to each other in a very close environment, then you can actually pick up these massive savings in terms of energy and massive savings in terms of efficiency. And I've got the chart up, which that they're sort of showing is how they're, this is one of the charts that NVIDIA is sort of splashing around the place. And they're basically saying that the column to the left is the Ethernet. So that's your effectively, you're plugging computers into other computers and saying, you can run that for sort of 150 odd meters or less. And you've got this sort of power and how much that's costing you per gigabyte to do things. And then you're saying, well, if you can have these chips really close to each other, then sort of within a meter and a half, then you can sort of reduce that by 10 times in terms of the cost of the whole production. And then if you're talking about stacking these chips on together and running your memory within the same thing, then you're actually getting to this stage where it's almost free and it has to be really, really close, but it's much cheaper. And NVIDIA is dominating those right two categories. And they're building the whole ecosystem behind it. Now, others will probably catch up and at some point or whatever, but they've got a pretty decent lead. And the question is, are they right? Because if everyone's going to build data centers on the back of their technology for the next 5 or 10 years, and it's going to use not just their chips, but the integration of their chips with the memory and the integration and effectively their design and structuring of these data centers, then they're going to make a lot more money from it. So that's one part. So, and you do have, some pretty big players out there all trying to build in chips, and there's lots of competitors that are potential. And the other wild card is, though, there's this real FOMO we're getting in terms of companies who are basically saying, we're at this early stage of the boom in terms of saying the companies know they need to do something in AI, but they don't know what. And so if you don't know what, maybe we need some processing power so that once we've worked out what we actually want to do we can run the calculations. And so let's set up some data centers and do stuff like that. So there's some companies doing that. And then on top of that, we've got governments out there doing it as well. And the government side is, well, from a military perspective, there is FOMO out there, because if another military cracks this whole AI and can all of a sudden run swarms of drones and all this type of stuff like that at you, then your military is suddenly obsolete. And so there is an arms race, starting to kick off, and they are looking at spending serious money on all this equipment. And so the question sort of comes down to saying, okay, is NVIDIA in a bubble? Yeah, maybe. Is there a credible path where they can actually, they can keep growing their profits to justify the share price? Yeah, sure. Is there a credible path to where this could become a much larger bubble than what it is at the moment? And on that one, I'd say absolutely. I think there's there's very much a part in terms of saying, this, are we at the start of a bubble? So if we were sitting in 1999, and I'm saying to you, Martin, yeah, look, you know what? The NVIDIA share price will be back to, within 10 or 20% of where it is now in 5 years' time. But in the meantime, it's going to go up 3 times in price. I guess it's the question about saying, look, do you sit the whole thing out? Or do you try and play around and look for places where you can take advantage from it? And I think there's enough, for me, there's enough real dollars being spent out there in this area of the market that I feel the need to be at least somewhat involved. And yeah, I want to be careful. I want to make sure I'm not buying these things that are just promising the world and not making any actual money. But NVIDIA, while it's expensive, is nowhere near the types of prices that, say, Cisco got to in its peaks. And there is genuine. It is going to struggle for the next little bit in terms of starting to cycle some harder numbers. But we're really going to tell whether over the next sort of 6 to 12 months, are they just a GPU story, or are they actually talking about becoming, the real sort of backbone of the new data center, and going from a small component of a data center to a large proportion of it. And as I said, I'm not completely convinced, but I think there's enough smoke there that you need to be aware that this is going on, and we could be sitting at the start of a 99 type style boom. And it's easier as an investor if you're saying, no, I'm going to sit the whole thing out. It's all a bubble. I don't want to get involved. As a fund manager, you need to take into account the fact that maybe this boom then turns into something else, and maybe we get some other productivity gains or something like that. And next thing you know, you find you're left behind, not participating in something that might have been much bigger. And so I think there's certainly being cautious, but there's enough there that I think you should be aware and think about it like a 1999 type style boom. Now, in terms of earnings and valuations, what does that mean? Look, the 2000 tech boom was extreme, like right out there in terms of all the models, blew past all these models in terms of how high it got. So I think expecting it to go to the same heights as that is if you're saying, if you're like, oh yeah, I'm going to take a margin loan out, throw everything on it, and when it gets to those heights, then I'll sell. Is like, no, that's not you. That expecting it to absolutely positive go there is not. But if it went halfway there, you'd add another 20 or 30% to the market. I'm assuming that if you did get to those types of valuation levels, there's at least going to be some earnings growth involved in this. So you're probably talking, another 50% rise to the market, sort of getting halfway there. And and if you go to the full extent, you're going to add another. Well, you're probably double the Nasdaq. The S&P might be up 60, 70% if you went back to the same levels, which I think is an extreme. It's an extreme outlier, but there's easily a case for it to go through a just a normal sized bubble, not the sort of super sized bubble that you saw back then. So I think it's not It's much easier to come up with a great view when you say markets have fallen a lot. There's productivity gains, all these types of things like that. Some fundamental things you're going to hold on to is much easier. It's much easier way to talk about. We should be getting out and buying the market. But at this point, I'd be certainly saying to people, if you've decided to sit this out because you think it's a bubble, the bubble could get a hell of a lot bigger before before it all finishes.
Well, the point is, it's very hard to define, the extremes of a bubble until it's popped, and then it's too late. But one observation I would make is, if you look at who the main customers are of NVIDIA, they are deeply cashed up, large corporations like Microsoft and the other players, right? Google, they are not Amazon, borrowing a lot of money to go and buy. What they're doing is using their own investments, effectively, their own collection of money that they've made over a generation. And what that means is that you've got this symbiotic relationship between a number of very large cashed up organizations who are able to buy and invest in the NVIDIA tools as they're developed. And that gives NVIDIA the passport to be able to actually invest big, to be able to actually continue to innovate. So that's a very interesting element, I think, in all of this.
Yeah, and actually I saw a comment pop up. Someone spoke about TSMC. And that's a really important point as well. It's a negative for NVIDIA and a positive. Probably more of a negative than a positive. The positive side is they don't build any of their own stuff. They just design these chips and give it all to TSMC and some others, and they build it all for them. And so that's why they've managed to, you think about the amount of growth they've managed to get. They're talking about doubling every few quarters. They're doubling the amount of sales they're doing. Now, if they were running their own factories, there's no way they'd be able to do that. You're talking 2 or 3 years to build these new factories and get them all up and running, and then you're starting the next one. And whereas this is just a matter of them saying to TSMC, well, can you shut down a few other lines and we'll pay you more for stuff you shut down, or we'll take more capacity out of your new factory. So that's a huge positive in terms of being how fast they've been able to grow. The flip side is somebody else comes up with a better design than them. There's no need for that person to have to go and build factories and spend 4 or 5 years getting to the stage where they can actually commercialize it. They can just go to TSMC and say, hey, here you go. Let's get this up and running. I think the other thing to note as well is I get a lot of people talking about, say, AI doesn't work that well. There's all these problems with it, all this stuff like that. Yeah, no, absolutely, sure. Martin, I'm sure you remember the internet in 1999 and 2000. You're like,
oh yes,
and it's a thing about, you can look and you go, online banking, for example. I won't have to line up at the bank all the time to cash checks, and I won't have to go pay my bills and all this. It's going to be fantastic. And then you'd get online, and it'd take you 2 minutes to actually start your modem up and get the whole thing going. And as long as nobody called you and bombed out your modem, you'd be able to go in there. And half the time the bank website didn't work properly anyway, and you'd still end up having to go to the bank. But the promise was there and the productivity gains were there. At the time, the banks had that same vision of like, oh, great, we won't need all these branches. But they still did at the time, because they still couldn't get rid of their branches because it was still the early days. The internet really didn't work that well. People weren't stopping completely going to branches. So you still needed the branches. Plus, you needed all these IT people to suddenly make the systems that would eventually mean that you could cut down on the branches. And then, and 10 years later, everyone's doing internet banking, and lining up in a bank is a thing you tell your grandkids about. The AI stuff is similar. Yeah, look, lots of it doesn't work, but the promise is there, and maybe some of it will never work. But there's certainly enough within that, and there's enough signs about what things that can do quite well that you can see where the future's going. And companies are in that same part where, let's say a grocery store is at the stage where it's trying to go, well, can this AI identify stuff as people are putting it in trolleys and pay and all that type of stuff like that? Yeah, sure. And does that mean you let go a few more checkout staff and there's all these other things you'll be able to do in terms of that? Yeah, sure. Can you do it right now? Probably not. It's probably not good enough. But you actually have to go out and spend the money now to have the people, programmers doing it, and get the cameras and do all the practicing and stuff like that, so that in 5 or 10 years' time, you'll be at the stage where I need half the staff to run this place. And so and that's the promise, and that's the idea, is that, are we going into this CapEx boom, which is we need to spend all this money now and we're getting almost no return out of it, and it seems really bad until eventually you get it back. And that's the I meant to look up this chart, the name of this chart, Martin, before I did it. This technological chart. That's maybe, I'm sure somebody can pop up in the comments.
I think it's a Gartner chart. I think it's Gartner.
Yes. And so the whole idea is that you have this technology trigger on the left, and you go into this boom, and everyone thinks about how great things are going to be, and you get this great inflated expectations about how fantastic it's going to be, and then let's use the internet as an example, and then you realize actually, we've built all these websites, but people are still coming to my bank, and so I can't fire all my staff yet, and I'm actually spending all this money on IT staff, and I'm all this stuff like that, and so. And then you go down the other side to the trough of disillusionment, and then you actually do get this slope of enlightenment, and I start to cut down my staff, and people don't have to go to the bank to line up to pay for bills, and all of a sudden we get this actual productivity side, and that sort of flows back through. That sort of same chart goes, pick whatever boom you want to talk about in terms of technological booms, or whether it be railroads or air, or whatever it is that you've got, and there's that idea that you have these inflated expectations, and then eventually you come into that trough of disillusionment. So how close are we to that peak of inflated expectations? Who knows? My guess is we're still a fair way away from the peak of inflated expectations. And so, if that's the case, there's something there still.
Yeah, and just to give you a little bit of context here, because I can remember pre-internet and internet, I was actually in a large bank in Melbourne at the time, leading the development of a business case for taking the bank into the internet age. This was before the 2000. There was another project running, the Y2K project, and we both went to the board in the same meeting. And I was presenting the future and all of the fact that, in the future, you'll be able to do this and that. And, the internet's going to be really important early days, but we've got to invest. We've got to lay the platform. We've got to think about content and customer experience, all of that sort of stuff. And then the other presentation was, if you don't invest in Y2K, you won't have a bank. And guess which way the board invested? They went through the Y2K, investment path. All the stuff that I'd been working on got kicked down the road, and I think the bank missed a major opportunity because we were very early in thinking through the potential of this stuff. And I just want to make the point that while the technology might be able to do stuff, there's a broader set of questions inside corporations as to how serious they are about taking some of these things. There's a lot of lip service to AI at the moment. I'll be very interested to see how much of it translates into something that's really transformational in the way that businesses work. Some of it will, but I suspect a lot will fall by the wayside.
Absolutely. And we spoke before, everyone, there's all these things about, I used to employ a statistician. Now I've just changed their job title to a machine learning specialist, and I'm calling them part of my AI spend. There's going to be lots of bullshit behind it. But I do think there's certainly a reasonable amount of FOMO in boardrooms at the moment. And as I said, I think the thing is right now, people are like, well, I want to spend money on it. I don't know what to spend money on. Maybe processing power until when we finally work out what we want to spend it on. Yeah. I think those parallels as well is that there's that idea that when the internet was a dial-up modem and took ages to do all these things, you were limited. There was this whole growth that was needed to actually bring it up, and just the programming tools and browsers and all these infrastructure type things that really, that in some way add bucket loads of value, but in many ways don't add, there's certainly no direct correlation between, hey, a new browser just came out, all of a sudden we can, that eventually will lead to much greater productivity gains, but the person who's putting the browser out didn't really get those because it's broadly spread. So there's lots more to come in terms of that. And so, I guess I just wanted to highlight that how do you get involved in this? So we certainly have some ourselves, but we also run some of these idea that we run these tilts to portfolios. And so, what we have is that these core portfolios, whether it's an index fund or whether it's one of our funds that sort of sits in the middle. And then we say, look, what do you want to throw around that? And you can add all these tilts. We've got 100 different tilts and screens. You can knock things in and put them out. But yeah, some of these ones where, large tech stocks, you just want an extra exposure to them, or cloud computing, or artificial intelligence, cybersecurity, robotics. There's 100 different screens that we have out there. Where very cheaply you can just say, yes, you know what, I do think AI is going to be great. Let me have some of that, or maybe it's a different technology or a different factor you want to get exposure to.
Yeah, and that's the whole point about the whole Nucleus wealth and what the World Fund's concept, isn't it? Of flexibility and agility to be able to actually have transparency about what you're doing and also make some of those decisions. So that's one of the reasons why I think it's a really important and distinctive offering in the market at the moment.
Yeah, absolutely. I'm sure there's links, are there, Martin, on the thing to the World
yes.
Fund?
Believe me, yes. Go Walk the World, and from there you can follow through and get all the links to the propositions. And this is really important at the moment.
I'd love to have a chat with you around that whole idea and how you can do that, because I think that idea and what you're saying there, Martin, the transparency part is about saying, well, what have I got in my portfolio? And how does that sit with other things? So, I've got my super there, I've got my personal investments, you might have family trust, you might have whatever it is, you might have investment properties. It's about saying, well, if I can see them all, and then I can decide, you know what, I got plenty of, already own banking shares because I've already inherited some. So run me a portfolio, but don't give me any more banks, or even just don't cut the banks out because I'm worried about, the amount of property exposure or whatever it is. So yeah, very much that's our concept is portfolios you can customize.
Yeah, and in the current environment, I think that's great. And also, of course, you have transparency in terms of performance as well. So you can actually see what's going on. And unfortunately, quite a few of the other operators out there make it quite difficult to understand what's actually going on.
Yes, yeah, that's right. So and I think there's if we are going to this environment as well, for anyone who's sort of lived through this or hasn't really studied that much, I guess. The Australian stock market really wasn't the place to be. It was the old economy, and so it didn't. Australia sort of had a little bit of a balloon. It wasn't a massive bubble, but it was it was a little bit. Whereas the US in particular and that whole tech sector was the epicenter where that really took off. And so I think there's definitely a parallel there. If there is going to be a boom in this part, and you want to take, you want to at least play around the edges, then buying Aussie banks and Aussie miners is not a, despite sort of the investment banks telling you that copper is the AI mineral, it's not. And that was part of this latest boom, but it was the whole idea, and there's lots of truth into the fact that we're going to need way more copper. If this is the case, that NVIDIA model we spoke about needs way more copper than the old ones. And you're like, yeah, but data centers are like a fraction of a tiny percent of the whole market. Like, there's just not big. Even once you take into account there's this you talk about how much is going to get used by that, plus all your EVs and your wind power and your solar power and all that type of stuff like that. And you're like, you're going to find that the energy sector might triple the amount of copper that it needs over the next 30 years. And you go, yeah, but it's such a small part of the overall market. That means even if it does triple, it means we need like an extra 1% of copper per annum for the next 20 years. It's like, sure, yeah, it's great. Prefer to have it rather than not have it. But but the flip side is it's what happens in the Chinese property market is more important to copper than what happens in that. If the Chinese property market halves the amount of copper they're going to use, copper price is crashing. I don't care how much is getting used for sort of electric vehicles and those things.
So clearly the US market is a critical component of investment performance, and in fact, if you compare the growth in the Australian market over last year at about 7%, and the US, the US did a lot better. In fact, we did better the previous year in Australia than last year. But of course, there's another factor in the US, and that is the recent debate, the upcoming election. I have a feeling that looking at the bond yields and those sorts of things, markets are beginning to wake up to perhaps a more wider range of potentially more risky outcomes. I wonder
Yeah,
how you factor
uncertainty.
that into the investment thinking that you're doing, and can you prepare, or do you just have to wait and see what happens? I mean, how do you think about it?
Yeah, well, I think there's certainly an uncertainty component that's come through. So, and I guess what I mean by that is, we go back 2 weeks or even a week and a bit, pre debate, pre the latest Supreme Court, and you got a convicted felon, um, and I guess with a number of other court cases coming up, and so the probabilities of getting of whether he gets through or not. And then in the last week, we've come out and the Supreme Court sort of backed him to the hilt, I guess, in terms of saying, yeah, we've got your back. Don't worry about any legal problems. We'll sort them for you at least until after the election. And then Biden's come out with a pretty poor performance at the debate, and so there's a reasonable chance that somebody will get parachuted in. And if somebody gets parachuted in, they might wipe the floor with Trump, and they might be like, great, we've got someone to vote for that isn't almost 80 um, uh, and the oldest president ever, or maybe it ends up being, here's a new person, they haven't got the experience, let's go with somebody who's got the experience again. So I think the range of outcomes all of a sudden got significantly wider. I think there's elements in terms of having a diversified portfolio. I think there are concerns you might have about you might have concerns about democracy and rule of law and things like that. That are I guess that maybe you think around the protection of the tail risks. I guess the flip side as well is looking at the last time Trump got in, it was a very company friendly suite of initiatives that he came out with, and certainly in terms of tax cuts and things like that, sort of drove significant growth in earnings. And I think there's certainly an element within Trump's side, I think, that would certainly be more than happy to run up bigger budgets. And so there is this idea that, well, yeah, if he gets in, do we need to think about that, having higher interest rates or higher inflation and running that economy quite hard? So there's that side, and then the whole unknown, who might get parachuted in instead of Biden, and what are their policies going to be? Will they even stand a chance, or will they get to do everything they want to do? So yeah, it's a time, I think, being relatively nimble at this point and keeping an open mind, and certainly the biggest thing I'd say for everyone is try and keep your own emotions out of it, in terms of, you might have a candidate on either side that you think, how can people possibly vote for someone so old that looks like they're going senile, or how can people possibly vote for somebody who's breaking the law and doing crazy things, but they're going to vote for one of them. And so you need to be open that, what are the possible outcomes, what's it going to mean, and where's that sort of driving.
Yeah, and just one quick thing to follow up on. If Trump does get back, he's talking about tariffs, and significant tariffs, right? Trade tariffs.
Yep.
Now, that clearly could be inflationary. And if, in fact, as a result of that, and as the tax cuts, they need to borrow more as well, that could put quite a lot of upside risk in terms of interest rates and bonds and those sorts of things. And that's, I think, one of the reasons why we've started to see a little bit of a sea change in the bond market in the last 2 or 3 days. I would argue that last Friday was actually a very important, potentially inflection point. Interesting to see how it plays out ahead, because the probability of higher inflation and maybe higher bond rates is something which the markets are beginning to perhaps think about. I don't think the Reserve Bank here, or thinking of the US, the Federal Reserve, will necessarily preempt any of that stuff, because they tend to be reactive. They're highly reactive functions. But there is an interesting change in the weather, I think, in terms of how some people at least are thinking about this.
Yeah, well, I think both those events, I think, both the poor performance by Biden at the debate, but I think probably more importantly was most most legal and what I would think to be relatively, I guess, well adjusted and even handed legal minds were quite surprised at how far the Supreme Court went to back Trump. And I think that's indications that they'll if anything else pops up, they'll sort it at least until the election. And then the other part is, and it's interesting as well that probably one of the other bigger decisions that might have been left behind is that they also decided that lost in some of the immunity stuff is they also made some quite large decisions on. It used to be that they would defer to government agencies when there was concerns, whereas now the expectation is now the courts have got a lot more power, and so does that cause more problems? Yeah, quite possibly as well.
Yeah, well, I have this sort of nagging thought that what happens if there's a Liz Truss equivalent moment? Remember what happened in the UK with,
yes,
Truss coming in and doing a whole bunch of stuff that the markets didn't like. Could you actually see something similar in the US? And of course, because of the fact that the US is such a large investment market, that has potential risks attached to it too. So being agile and nimble at the moment is probably the best strategy, because it's very hard to sort of, work out where this could play now, because the potential alternative futures are quite dramatically different.
Yeah, and I also want to talk through this idea as well. Although I do think there's an inflationary, it's certainly true that there's an inflation. You'd expect a higher inflation based on these ones, on a number of these factors. But if you're looking at quite punitive tariffs on China, then China's quite possibly in for a lot bigger problem than what we've discussed, and they're also going to be exporting deflation as fast as they possibly can. Now, it might not be directly to the US, but it's probably going to be to a lot of other countries. And there's a lot of there's a lot of moving parts within that whole thing. Is that you say, well, if there's not heaps of more stimulus, but there's lots of tariffs, then there's this short-term burst of inflation. But at the same time, you've smashed China, and China's now going through some serious economic problems and exporting deflation as fast as it can, and maybe that means the inflation doesn't end up being as high as what you think. Or is there another big tax cuts and unfunded liabilities and things like that coming? And there's I've forgotten the name of I'm going to write some of these things down. I forgot the name of the model, but there's a model that basically looks at global economies and effectively it sort of talks about there being consumers, corporate profits, and government spending, and some other bits and pieces. But basically the whole equation solves to when governments spend more money, then corporates make more money. Is depending upon it's either got to go to raising wages for people, but usually what happens is it ends up all as corporates make more money. And so this is one of those factors about saying, okay, yes, we might be looking at higher inflation, but if we're looking at higher corporate profits as well, because the money's pretty much going from governments across to corporates, then you need to. I guess it's an argument for more equities and less bonds.
Yeah, absolutely. Well, I've certainly read a few people suggesting that is the way to go. So it'll be very interesting how it plays out. But let's come just to Australia a little bit, because of course Australia is on the fringe of this. The Australian economy is very strongly connected to what's happening with regard to China. But the RBA minutes that came out today indicated that they discussed keeping rates on hold or lifting them. There was absolutely no discussion of cutting rates, and that was before the quite hot CPI number at 4%, or well over 4% if you look at the core. And so a number of economists are now starting to say, well, maybe the RBA is going to have to lift rates, bearing in mind a 4.35% is quite a lot lower than the rates that we've seen in the US, or indeed New Zealand, or even the UK. So that is a very interesting and important observation, insofar that I've seen in my models quite a few people who were in significant financial pressure getting help from the bank for 12 months. Those 12 months periods are now beginning to come to an end, with an expectation when they went into it that rates would be a lot lower. But maybe they're not. So there's a big question mark now. RBA policy, are they going to lift rates, or will the the government intervention with regards to the tax cuts and the energy subsidies and other bits and pieces be enough to take the pain away? I think the Australian economy is looking pretty shaky at the moment.
Yeah, it's not well. I think the interventions to have a government are not well targeted. I think we've spoken several times about this, and I think you had Dave on as well at one point talking about the whole gas and the problems in terms of effectively what we've done is opened ourselves to the world, and now these gas companies are basically running a cartel and rorting us for as much as they can. Yep. They're basically taking as much as they can get away with. We're one of the biggest exporters in the world, and we're paying some of the highest gas prices locally because they can get away with it, and so. Then to turn around and say, well, why don't we give some households some money that they will give back to those companies so that the companies can keep charging the higher prices to keep inflation down doesn't really feel like a solution as much as it's just donating more money to the cartel. And so, yes, I don't think that's doing so at the headline, that's doing something to bring down inflation to people on the ground, but you're just paying for it in your taxes effectively. You're just saying that rather than charging you an extra $100 on your bill every quarter, I'm just going to charge an extra $100 of tax, and then I'll pay that back to the gas cartel, which is overcharging by $100 a quarter. So it's like, well, why don't I just tell them to put their prices down by $100? Then anyway. We won't go into that, but I guess what I'm saying is that's not this huge thing. We've talked about cutting the number of people coming in because that's sort of jam loading all the system and causing problem with housing and all that type of stuff like that. But the levels they're talking about bringing it down to are not levels which would give much relief. They're still much higher than historical ranges, and probably more importantly, to me. The way the incentive schemes are sort of set up in terms of bringing people in, they still seem to be skewed towards bringing too many people. I guess what I'm saying is if they're going to fail, like they failed miserably on their target. I think they targeted, can't remember, was maybe 300,000 or 400,000 people, and they brought in 700 or 800 or something like that. They might have missed by close. Well, maybe if it wasn't 100%, it was pretty close. And now they're talking about bringing it back to these levels but I feel like sometimes when you look at the governments clamp down on things and they overcook it, and you push out the other end and you don't bring in enough people. This one though, it seems like it'll probably be too weak, and they'll probably bring in more than what they think, and then they'll try a little bit more, and so I don't think there's any real relief coming on that front. What else have we got? And then the question about saying, well, look, we've got inflation in education, we've got inflation in healthcare. Both those are sort of largely person-driven as well. So, they're going to go away without sort of, significant increases. So I think we'll be getting deflation from overseas, particularly in China, but offset by poor policy in Australia, which is not going to, is really going to be about, trying to make us feel better about the inflation rather than trying to fix the inflation.
Yes, and again, it's quite interesting watching the various discussion points that people are sort of trotting out, and Chalmers keeps coming out with saying, well, no, it's not going to be inflationary. You've got Michelle Bullock saying
the tax cuts, but if you give everyone all this extra money, that won't be inflationary.
No,
of course it won't be inflationary.
No. Well, let's just think about definition of inflation, right? But the other thing is that Michelle Bullock did actually say previously that they'd look through the the temporary support. Of course, if you look at the electricity, there was support over the last year or two, same with rents, and that actually did pull the inflation down. But the ABS kept reporting what it would have been if it wasn't there. So it was a temporary thing. And then, of course, you've got to keep going with it, or inflation jumps back up again. So I think
the real thing that would cure inflation, though, is a recession.
Yep. So, I was going to say exactly that. If you argue that the issue is that there's still too strong demand, which is precisely what was in the minutes, then you've got to say, well, what's going to dial back demand? Well, you could dial back migration. That would actually reduce demand, but there doesn't seem to be much of that going on at the moment, despite all the talk about students and what have you. the job situation is a little bit interesting insofar that the ABS statistics look quite a lot stronger than some of the other jobs data that we've seen, for example, job openings. But the employment looks quite strong. So there seems to be a need to create a better balance between demand and supply. That's, I think, what the RBA is saying. So how do they do that?
Yeah.
Well,
the jobs part's really interesting insofar as most of the central banks have commented on a similar type of thing and talked about saying, well, actually, maybe our job numbers aren't doing what they used to do in terms of, we're just not capturing what's really going on. Maybe jobs are a lot weaker than what some of the figures are showing. And arguably in Australia, that'll actually be worse because Australia sort of looks at this group, they sort of take this group of people, and then every month or every 3 months as they do it, they sort of drop off part of the group and add a new group in and all that.
Every month.
But if you've got record numbers of people coming into Australia, then that group doesn't reflect that there's this record number of people and what's happening in terms of those. You're just looking at saying, okay, well, of the people that are currently here, here's what's happening. But yeah, if you sort of have that big change coming in, then arguably Australia's we've got even less information in terms of that than about what's really happening. And so, yeah, that's a huge. I think that's going to be a huge driver in terms of working out whether we do go into a recession earlier or not. Is that if the numbers that we're reporting on jobs are right, then things are a lot safer, and job interest rate hikes are probably justified, and the economy can probably handle it. But if those numbers are wrong and we're raising interest rates into a much weaker job market than what the RBA expects, then that's where the recession could end up being worse than they intend.
Yeah,
and of course we're already in a per capita recession.
Good. I was going to make that point. I was going to make 2 points. Firstly, the per capita recession, which has been now six quarters and continuing, and compared with the OECD, we're way underweight in terms of the income per capita. But the other point there is that the whole issue of how long this takes to work through, I think one of the things which is probably the lags are longer than people were expecting, and so we may not have seen all the impact yet of the higher interest rates working through the system. We are seeing, though, a lot of businesses falling. In fact, we've seen business failures, particularly in the construction industry, at some of their highest levels for a long time. And so there are signs.
We need more houses. Well, we need more houses for people to live in, and our construction companies are falling over.
Yeah. Well, in fact, there was an interesting article that blamed the Western Australian government, in particular, for their housing support policies, for the pressure on the building and construction sector, and the fact that they actually, had real issues because of it. So there's a lot of interesting questions, and the database that we've got looks a little wobbly. Interestingly, the new deputy governor, the guy from the UK, basically said, well, we won't just take one number, we'll look at a lot of other information, which I always think makes it sound as though they've got this wonderful mystique about what they're doing. We got so many lots of information, we're going to make much better decisions. The RBA has not made good decisions. I would argue that they didn't lift rates high enough, quickly enough. It didn't follow some other countries. So we've got this sort of middle ground where inflation is still quite homegrown. We've still got some benefit from the employment growth. But the longer this goes on, it's like the pain's extending. And the trouble is that as the pain extends, without actually seeing an end to it, then it suggests they may have to do more to be able to actually get to a rate where, frankly, they're going to create a recession.
Mm. And as you said, it's look, I mean, I always prefer having more data that I can look at rather than less, but it's also the part about saying if I've got, if I have 6 different signals, then I can just cherry pick the 2 signals that tell me what I wanted to hear, and let me use those ones this time around. And there's often, you can usually find one or 2 signals that will back up whatever your predisposition was. If you're using it in a systematic way, then I'm certainly more than happy to do that. But yeah.
Well, there are a few commentators who are very precise about which measures they pick, and you think something. Well, hang on a moment, is this cash for comment or what?
Yeah, that's right. I'm going to use this one now, and then at the other end of the cycle, I won't even mention this one at all. I'll flip to a completely different measure that tells the story I want to tell at that point. But yes.
Yeah, absolutely. Just want to say thanks very much to Jason for his support there. Greatly appreciated, Jason. And thanks very much for your comments this evening as well. I really appreciated them too. Now, one question I wanted to ask you, in the context of a wobbly US economy, possibly, but a definitely wobbly Australian economy, and by the way, of course, New Zealand's already in recession. CBA. CBA is, well, the valuation of CBA, I can't make any sense of it. Why is CBA so overvalued? Or is it overvalued?
Well, it's pretty much the most expensive bank in the world. Certainly the most expensive large bank in the world. So, if you made, there's I think I've probably spoken about this on your program before. There's a reasonable argument for banks is that given the way they've operated over the last 20-something years in terms of being government guaranteed and effectively, the Australian banks are effectively, well, they're not explicitly, there's some thought behind that, and being close to the regulators as to, if you're close to the regulators, you can charge more than what you might if your regulators were a bit harsher on you. And so if you're going to run it with the argument that Australia's we went through this, what would seemingly be an incredibly damaging Royal Commission, and the banks, I don't know if they got touched, were they? Like there was a few, there was a couple of people fell on their swords here and there. One or two board members.
They've got the bear regime, right? That was basically about it, right? So
yeah, but the odd board member here, out of the whatever, 100 odd senior people, board members of this, maybe one or two of them had to fall on their swords. So, 2 or 3%, hit rate on that. But yeah, they made it through. And so, I guess there's this argument that's saying, well, they're so close to regulators, the Australian government will back them on anything. They'll let them keep charging more than what they should make. So therefore, we can price it at a higher price. That's the best reason I can come up with it. But it is, it's crazy expensive relative to banks anywhere else. Right?
Yeah. And interestingly, I've spoken to a few analysts on this. They can't understand it either, because the margins are actually being compressed at the moment. The cost of funds are rising. The bad debts are rising. So what is it? I mean, it must presumably be because the market believes that, well, the government will always support the banks. Yeah.
Well, and then the other part is worth just remembering as well is, the Aussie banks are 40-something% of the Aussie market. It depends on how you want to measure all these, but, versus most other markets, it's 10. And so, an investment in the Aussie market, if you're just investing in just the index, you're taking 4 times as much exposure to the banking sector as what you'd get in just about any other economy.
Yeah.
So it's it's a big question, but it's also a major risk to the Aussie market in terms of performance and
well, I suspect we'll be hearing the discussion about financial stability quite soon. I'm pretty sure that there are people. I mean, ANZ was arguing the other day that they're not now able to lend to large swathes of the Australian population because the rules are too tight. And so they're looking for some ability to be able to lend more broadly. Talking their own book, of course, as you perhaps might expect.
Somebody's put interest rates up, and our customers can no longer afford loans. Can you let us change the rules so that we can lend to these people?
That's exactly right. Rates? Yeah, exactly right. And I've seen quite a few people in the financial sector arguing that that's what they should be doing. And of course, APRA, APRA is another of those regulators that are, I'm not sure they're really doing their job. So financial stability, I think, will be something which we're going to hear quite a lot more about. But I wanted to make the point that if you look over the last 12 months, CBA's done quite well, but that was not the most high performing stock. It was actually a couple. Life 360, for example, is one that's done really well over the last 12 months. And my observation is that there have been a couple of stellar movers, which were actually not necessarily easy to predict ahead of time. And I guess that's an interesting observation about the dynamics of our market. We do sometimes seem to have little bolters that go, but structurally, the performance of the market here is just, well, it's a pale shade compared with the US, as we discussed earlier.
Yep. Banks, resources, and some of the utilities, so the Transurbans and gas pipelines and all that type of stuff like that make up 60-odd% of the Aussie market. And you go elsewhere, and it's those three sectors might be 15%. It's very different in terms of and that's why we sort of encourage most of our investors to get a pretty decent exposure to international stocks, just because you're as I've said here on this program, I'll say it more times. If I was a US or a UK financial advisor, and I went and told someone, hey, you're going to put 60% of your money into banks and resources, if anything goes wrong, I've lost my license. I'm gone. Whereas in Australia, that's the market. That's what everyone does. We just throw you into those sectors. And so, so I guess in terms of thinking about the rents, and the other thing to think about just in terms of those companies, I said 65% of these companies are in these sectors, is that, if you're talking about growth, okay, so resources, we're just digging stuff out of the ground and selling it. Yes, there's not a lot to, Australia does a great job of it, and it's, pretty safety oriented and relatively technologically, but it's not a new industry. It's one of the oldest industries. And you don't make great profits in that for most of the time. Every now and again you do, but most of the time you're not making great profits. Banks are a cost on the rest of a society. Banks lend to other companies in order that other companies can grow. So when the companies that are meant to be helping the rest of the economy to grow are 40% of your market, it's like, well, just is that have we got it the wrong way around? These are the guys that so they're a sort of net cost for productive companies. And then all these other ones I was talking about, the defensives, like when you go real estate companies and toll roads and all these types of things like that, they're exactly the same, where, I own a building and I'm just going to charge people to come and work in it. That's not a productive, it's obviously helpful, but it's not like you're out there creating things. Or I own a toll road and I'm charging people to drive on it. Or I own a gas pipeline and I'm charging, gas molecules up and down it. They're not innovative companies that are out there trying to grow the economy. They're landlords effectively, or rentiers trying to make as much from something they already have. And I guess in terms of saying, well, in a brave world of AI, and if things are going to change and you're going to see new companies pop up and things like that, are they more likely to occur in economies where most of the companies are out actually trying to create new services and products that people might want? Or is it going to come to a nation where 60% of our market is rentiers and companies that dig up dirt and sell it for a living?
Yeah, and just on that, going right back to the energy discussion that we had a little while ago, just to underscore again that we're paying about 5 times what we should be paying for energy in Australia, particularly because of the gas issue, which feeds into the marginal cost of electricity, which means that many corporates who would be doing things can't do things because it's too expensive. So our last plastics production entity is gone, right? So effectively, we've now got to import. So we seem to be continuing to narrow and narrow and narrow the economic base of the country rather than building it out. And I don't, frankly, give much weight to the recent announcements with regard to what Alba was going to do with his innovation programs and things like that. So I'm not sure how this plays out positively, as I guess what I'm trying to say.
Yeah, well, there's every prime minister since we started this had an innovation idea and innovation, and it's all going to be about we're going to grow these companies, and they all love to open some open ceremonies and cut ribbons and all that type of stuff. But there's no real there's certainly no real impetus. Actually, the best thing going for some of the Australian companies is the US policies, is Biden's policies for that sort of capture Australia's under the Inflation Reduction Act. A number of companies are captured with that, where basically the same benefits, well not the same, sorry, but it's certainly you get benefits as a friendly country that let you sell into the US, and so there's that's probably been our best industrial policy is come from another country. And so, yeah, I certainly haven't seen any, and this is not, for anyone who thinks it's a slight upon the Labor Party, it's not. It's a slight upon the Labor Party and the Liberal Party. They're both sides of neither side has come up with positive industrial policies.
Absolutely. Now, just as we come towards the end of the show, I've got one last topic briefly. I want to just touch on energy from another angle, because, of course, Dutton has come out with the nuclear option, literally the nuclear option. And I know we discussed some time ago the relative costs of nuclear versus, other forms of energy. I wondered whether you've got any reflections on that recent debate, and whether, in fact, there's anything in it, or whether it's really just all politics again.
Yeah, it's all politics. More detail. Well, look, the thing is, it's for me. Look, if the argument was we need to have nuclear, it's more expensive than other forms of power, but it provides diversity of supply, and base load. I can buy that argument. Yeah, I've got no problems with that. If that's what you've decided to do, but it's pretty disingenuous to argue that it's going to be cheaper, because it's not. Or if it is, it's this technology that is being promised. We've spoken a few times about the small modular reactors. They've been promised for years. They're not running really anywhere. And so that it's like, I've likened it to in the early 2000s, when climate change was a concern. Australia decided that no, it's all fine. We're going to have carbon capture and storage. That's going to sort us all out. Don't worry about that. Keep digging up the coal. Keep burning it. Carbon capture and storage. Yeah, we've thrown $1 million here and $1 million there. That'll solve the whole problem. Now, that was all just the technology didn't work, or certainly not at any cost. Any cost that made sense, but it was a great excuse just to keep doing what we're doing. And so, and that's my take on the nuclear as well. It's just it's one more reason to not do anything except keep digging up more coal and burning it. I think there's I've certainly done the numbers over time to look at where the benefits are in terms of and where it stacks up, and I've always done it as a X subsidies. Like, you got to strip out all the subsidies in either direction to come back to the right numbers. And it's just that real stark thing you get when you take longer term views and you just look at that solar price coming down year after year after year after year after year, and you're like, sure, solar doesn't shine at night, it's intermittent, all this type of stuff like that. Absolutely, you need storage. Solar plus storage is what we need. But if you add the storage cost is coming down at this massive rate as well, and you just go, okay, am I going to bet that this thing that's been halving in cost, if you take solar, the cost of solar plus the cost of storage, and that's been halving every sort of 3 or 4 years for decades now in terms of the cost, am I going to bet that that's going to come to a sudden stop and there's no more technological gains to get from either of them? Nah. There's lots more technological gains. It's just a question of when we're passing through that phase, and so and we need to have the right. Ideally, a country that's got so much gas would have been fantastic 20 years ago to all of a sudden start switching off all the coal and start putting on all gas, which is effectively exactly what the US did. We've got all this cheap gas we can use. That's this transition. And then as we're starting to move into more and more renewables, well, gas can turn on and off really quickly. It fits really well. It means that as the intermittency problems are no longer anywhere near as much as a problem. And then we're off, at some point in the future when storage gets to cheap enough levels to justify it, we can go to a much, much cleaner grid. But we're stuck now in this. I don't know what the answer. It's too late to build the gas-fired ones, because the gas-fired ones, by the time you've built them and run them for a quarter of their life, they won't be economic anymore, because, well, first of all, we charge so much for our gas, but secondly, domestically, and secondly, by then the renewables will be eating their lunch for them, and so so we're in this position where we've caused these problems to ourselves, and now it's a question of, are we going to have real policy to get out? to try and drive the solutions, or are we just going to and I think there's a little bit of policy from Labor on it, in sort of vaguely in the right direction from times, but I still don't think there's not a lot of. I think it's more from them. It's more about virtue signaling, but the flip side is that from the other side, it's basically saying let's just keep running everything the way we're going at the moment. So.
Yeah, and the point there, of course, Smooth made the point that gas is too expensive. Well, that's because of, as we discussed earlier on the East Coast, because of the
go to the West Coast.
yeah, totally different story. And I guess the problem that I see is that there's still a lot of politicking around this, not a lot of really good policy. And the clock is ticking with regard to the failure of the old systems. And of course, the most recent reports on the reliability of the power system over the next 2 or 3 years is actually looking pretty shaky. And that's a problem.
And the other thing I want to highlight is, look, it's a question about, without wanting to sound too socialist about the whole thing, is that, should we have monopoly assets run by people who are trying to make profits out of them? Because when there's a very good argument that when governments are running it, they run it really inefficiently, and there's problems, and there's all this stuff like that. I buy a lot of those arguments. Yeah, it can be really inefficient. And there is a question about what you should outsource and everything like that. The flip side is when you give a monopoly asset to a for-profit company, what do they try and do? Well, they try and maximize the profit. That's what they do. And they're very efficient at pulling money off governments. Absolutely. They're efficient at pulling money off governments. And I guess the problem I have at the moment is, we keep talking about what a great, we've got this fantastic network and transmission. We need all this extra transmission. And to a certain extent, we do need extra transmission. But part of it is the transmission companies are basically all owned by for-profit companies, and most of them are foreign owned. And so if you ask them what the solution is, it's more transmission. Yes, we need more transmission. We'll build it for you and charge you, and then we'll put more through. And so, there's not I'm worried that if we're trying to rely on all these companies that got us into this mess in the first place and are muddying the water deliberately to then come up with the solutions for us, then we're going to have problems. And we ran into a lot of problems with Gillard, in the Gillard years, where they basically let all the energy companies gold plate all their assets, so that because they all earn those regulated returns. And so the question was saying, well, I could run an extension cord from this room to that room, and that'll cost me $5. Or I could build a $300 million solution to, with substations and transmission and all that type of stuff like that. And I'll do the $300 million one because I get even though it's way more expensive, because I get to charge, a regulated return on that asset. And so, I guess I worry in this whole energy sector is that's who we're relying on is the companies that are basically trying to maximize profits from charging the government whatever they think they can get away with. And not to say, I invest in some of these companies, so I see it from an investor side. Like that's part of the issue with investing in Australia is you need to look at the structural problems we have and just go, well, you know what? That's a terrible way to set things up. Those companies are really going to rot taxpayers. I'll invest in them until we get to the stage where we start, having policy that's sort of pointed back towards, giving more power back to the consumer. But that's not happening anytime soon.
Well, I always think about some of the discussions we've had previously with regard to the power of corporates to be able to actually set an agenda, which means that they actually are able to yield superior return to shareholders. And, I would argue that the financial services sector, the energy sector, and I can go sector after sector after sector, the insurance sector is another one, they can all do it. And that's essentially because of the way that the structure works in Australia. So it's wired in. And by the way, returns aren't necessarily that flash relative to internationals, as we said earlier on, but they'd be even worse if, in fact, things were actually thought about from a practical, cheapest, best solution rather than the lobbied alternatives. So for me, that's part of the story of Australia.
Yeah, well, and look, I hope, in a way, I sort of hope that some of these politicians are getting paid from these companies in ways that I can't see, and they're making a much better return on it. Because it's sort of a bit sad that for a few $1,000,000 you can buy policy that's going to save you billions. And it's saying, well, okay, politicians might sell themselves out, but at least can they do it for something? Do it for an amount that's worthwhile.
Yes.
If you're selling out for a few $100,000 worth of, directorship somewhere, and next thing you've sold the company out for millions and hundreds of millions of dollars. It's like, well,
revolving doors are part of the problem. Yep. Absolutely, revolving doors are part of the problem. Well, Damien, thank you very much for your time tonight. Really interesting conversation. It sounds to me as though the next few months will be quite unpredictable with regard to investing, that effectively maybe a veer slightly more towards equities rather than bonds might make some sense given what we're seeing, but there are a lot of uncertainties, and therefore being agile in terms of how you set things up probably is the right strategy for the next few months.
Yeah, absolutely. And it's coming into, so I guess we'll probably, well worth us chatting monthly, I guess, until as we run into this US election. It's certainly very interesting.
Yeah, absolutely. Well, hopefully we'll do the first Tuesday next month, which will be the day when the RBA decides or doesn't decide, so it'll be quite relevant. But by then, maybe we'll know more about the US. We've put links and things in below, and folks, I do recommend having a look at Damien and what his firm Nucleus Wealth does. It is beyond doubt one of the most transparent operations, and I think it's really worth taking a look. So thank you once again, and we'll look forward to seeing you in a month's time.
Catch you then.
Great. Well, I'll take you off and I'll close the show. Thanks, Damien. See you later. There we go, folks. I hope you enjoyed that. Just to say that next week, Veronica Morgan will be on, and we're going to be talking specifically about the conundrum of first-time buyers in the rental sector. Trying to work out that puzzle, because I've got some really interesting questions already coming on that. So if people have other questions relating to the transition from renting to first-time buyer, send them through. And we'll look forward to seeing you then. Meantime, just to say that the dogs, well, I've got sort of bits of dog, really. We've got Luna spread out over 2 baskets and Meteor's in front, so you can't quite see her, but the dogs have been quiet, so this is good. And check out the other shows over the next week. There will be some very important information coming up on information in the interest of the people, because the report on ASIC is due out tomorrow, and John and I will be making some shows about that, so watch out for that. Check out our other shows, and I look forward to seeing you live next Tuesday, and thanks very much for spending some time with us this evening. Have a great week. This is Martin North from Digital Finance Analytics, signing off. Cheerio.